Hello. I'm a little bit disheveled this morning because at the last minute, my guest for today had to cancel. My guests, I should have said, for today had to cancel. They had an emergency with their child, and I mean, it's unfortunately they can't be here, but understandably, when it's your child, so that takes priority. So had to do there's a name for it in sports, a quick sort of adjustment here, and so it's going to be just me for today. Sorry about that for those of you who are expecting somebody else, or well, other people in addition to me. But we'll have them on at another time, and hopefully everything will turn out okay for their child. And for those of you who are parents, I'm sure you have experienced this, these kind of occurrences more than once in your life, and they can be, just a little bit frightening. It is your child after all, and of course, it does disrupt the one's regular day, and especially on Mondays seem to be so crazy anyway, right? And right after Father's Day. So I wish them well, and hope that everything works out okay with their daughter, and we'll we'll do a quick change up here, and I'll pinch hit for them today, and we will proceed. So anyway, hello. And this is Trusts and Estates Weekly, and I'm your host, Kevin Bemmel. We're here every Monday morning. Well, Monday morning West Coast time, 10 a.m. and 1 p.m. Eastern time, an hour in for Central and Mountain time. And our purpose for being together for this 30 minutes each Monday is to talk about all things related to trusts, estates, probates, dealing with our property, and making sure that it I just got a guest here. Hold on one second. Pin me. Okay. Dealing with all of those things that may happen to our property after after we die. It's not a particularly pleasant subject. But I think it's one that we need to deal with. The reality of the situation is, if we don't make some kind of plan for what's going to happen with our assets after we pass away, so then the state government, for the most part, is going to make those decisions for us. So there are laws on the books in each state, essentially determining what happens with our property if we die, what's called intestate. Intestate means without a will and without a trust. And so, like I said, the state will make those decisions for us. They will look at the various laws as to who gets what based on how close a relative they are to us. And if they can't find relatives close enough, then the state will take our money and they will keep it. So we may have a very close friend, for example, who we want part of our property go to. If we don't arrange that prior to when we pass away, the state is not going to give that property to that person. They're not related to us in any way, shape, or form. And so therefore they will be excluded. The person, of course, can fight it. They could mount a legal case and try and convince a judge that indeed it was your intention for them to get whatever property it is they believe you wanted them to have. But it's a tough fight. It could be costly, and so really the prudent thing to do is to make sure that we handle these things while we're still able to. And so that's our purpose here. And for those of us like me who are professionals, it's our job to help our clients, help people deal with these circumstances, and help them understand the various issues, so that they can make informed decisions, ones that will best express their wishes, their values, and be in line with the relationships that they have. So for today, I was actually going to cover this next week, but like I said, I did a quick change up here. I'm going to talk about about gift tax and making gifts while we're still alive. And the reason I want to cover this is it's not necessarily it's not necessarily necessary. I know that sounds weird, for us to wait until we pass away to start distributing our assets. So there may be good reasons to start making gifts to the people we want to have our assets before we pass away, and there are rules about that, and we have to make sure that those are taken care of. And there's an important change happening soon that for those of you who have very large estates will make a big difference. And so I'm going to share my screen, and we're going to take a look at some information on this is the website for the Internal Revenue Service. So, that is the tax collecting agency here in the United States. Okay. And there may be, by the way, rules about gift taxes in your individual state. I should preface my remarks by saying none of this is considered to be tax advice, legal advice, accounting advice. I'm taking you through the IRS's website so that you can see what the IRS is telling us about these circumstances. But of course, as always, before you do anything, make sure that you are acting in accordance, or you getting advice based on your own individual situation, so that the decisions you make are based on your situation, not on some general information that you got from me or frankly anyone else. Okay, so first of all, let's talk about what a gift is, and they don't okay, so I'm going to take what is considered a gift. So a gift is any transfer to an individual, either directly or indirectly, where full consideration is not received in return. Okay, so let's say that I give my daughter a gift of $5,000, and I get nothing, or I give my daughter, not a gift, I give my daughter $5,000 and I get nothing in return for that $5,000. And by the way, love and admiration and appreciation is not considered consideration. Okay, while we may desire that, okay, from the IRS's standpoint, that's not going to fly as consideration. Okay, so that $5,000 to her would be considered a gift. Okay, and now I'm going to talk about this in a minute. Whether that gift is excluded from the rules on gifts will depend on why I gave her the money. Okay, so but I'll set that aside. I'll get to that in a moment. Now, let's say I give her $5,000 because she worked for me for 50 hours during the past month. Okay, or she's going to be working for me for 50 hours during the upcoming month or two, right? So she's getting whatever it is, $100 an hour. Okay, I think my daughter's worth it, but don't tell her that, because she'll want an increase in her allowance. So in that case, I'm getting consideration for the $5,000 I paid her. So that would not be a gift. Okay, now What's the difference? Well, the difference is if I give her $5,000 and it qualifies as a gift, I'm responsible for the taxes on that money. Okay, so if there's a gift tax due, I pay it. Okay, now in the case, and we'll see this in a minute, there's an annual exclusion on the size of gifts we can give to other people, whether they're related to us or not, makes no difference. And so we don't have to pay gift tax on it. And we'll get to that in a couple minutes. Now, if I give her the $5,000 in return for her working for me, now she's going to have to pay taxes on that. Okay, at least income taxes. Now, depending on what the relationship is she working as an independent contractor, in which case I give her what's called a 1099. Okay, and now I don't have to pay any SSI, Social Security tax, or any Medicare tax on it. I don't have to withhold anything for income taxes. So she would be totally responsible for any taxes on that income. And in fact, she would have to pay what's called SET, self-employment tax, which is it's essentially just double. So it's the full income tax rate, which is over 15% now. Okay, for an employee, the employer and the employee each pay half of the Social Security tax, or what's called FICA. Okay, Federal Insurance Contribution Act, I believe it is. Okay, and they each pay half of the Medicare tax. When someone acts as an independent contractor, okay, so then that person is going to pay the entirety of that amount themselves. Okay, that's typically why someone who is working as an independent contractor will get more on a per hour basis than someone working as an employee, because they are automatically going to be paying an extra almost 8% in taxes, because they're paying the employer's share of FICA, what amounts to the employer's share of FICA, the self-employment tax. Okay, so in that case, like I said, if I pay it to her in exchange for her working for me, so she's going to be responsible for some or all of the taxes, depending on what the employment arrangement is. Okay, so now let's now just stick with a situation where the $5,000 I gave her is a gift. So what gifts then, or what kind of money can be excluded from gifts under the definition of a gift? Okay, so in general, the general rule is all gifts are taxable. However, okay, there are exemptions, and we can see this right here under what can be excluded from gifts. Okay, so gifts that are not more than the annual exclusion for the calendar year are exempt, and we'll get to the annual exclusion in a minute. Gifts that are tuition or medical expenses that you pay for someone else, okay, those are not taxable. So if I were to pay $5,000 for her to go to college, or give her $5,000 for her to pay for college, that's exempt. Okay, I don't pay gift tax on it. She pays no taxes on it. Okay, gifts that one person gives to his spouse or her spouse, okay, interspousal gifts are tax exempt, okay, no matter what the size. And finally, gifts to political organizations for its use. Okay, now the thing about political organizations are they may or may not be tax deductible. That depends on what type of organization it is. Okay, so just because you don't have to pay taxes on the gift doesn't necessarily make the gift tax deductible. Those are two different things. So for example, a gift to the campaign for someone running for office, that is not tax deductible. Okay, it's not. That's just how the rules work. On the other hand, the gift to an organization that is promoting an issue without endorsing candidates, generally speaking, that will be deductible. Okay, as just as any other charitable gift. Okay, so the issue, generally speaking, is the group endorsing any particular individual or individuals for office? If they are, then the gift probably is not tax deductible. Okay, if they are not, then the gift may be tax deductible. That's a separate issue from whether you have to pay gift taxes on it, which you do not, okay, when it's a political gift or when it's a gift to a political organization. Okay, now, may I deduct my gifts on my income tax return? That's what I was just talking about here. Okay, so you may or may not be able to deduct a particular gift, and that's what I was just talking about. So if the organization is a 501c3 organization, that's an organization that's been given nonprofit status by the IRS. They file a particular form to get that status. The IRS reviews it, and if they concur that it isn't a charitable or a nonprofit organization, they'll issue a letter essentially saying that the organization qualifies for nonprofit status. Okay, that's not our issue for today, so I'm not going to spend any more time on that. But understand that there's a difference between, and I want to emphasize this so it's very clear. There's a difference between not having to pay gift taxes on a gift and a gift being tax deductible, meaning you can deduct it from your income in determining your adjusted gross income or your taxable income. Okay, those are two different things. Okay, if you need to answer those questions specifically for yourself, now that's when you want to start talking to your accountant or your lawyer or both. If it's a large gift, then you may need to talk to both of them. All right, now, here's the annual exclusion per donee. Okay, the donee is the person who's receiving the gift. If you give the gift, you're the donor. The person receiving the gift is the donee. Or, as I used to explain when I taught real estate, the or person is the person taking the action. The E person is the person receiving the action. Okay, so you can see for this year, 2023, the annual exclusion is $17,000 per donee. Okay, now, so if I were to give $20,000 to my daughter, the first $17,000 of that is excluded from gift tax. But the remaining $3,000, I'll have to pay gift taxes on that. Okay? So one of the things that people do is they set up, and you can see that it's been increasing. For 2011 through 2012, it was $13,000, and over the last 12 years or so, it's increased to $17,000. So what people will sometimes do if they have multiple children is they will give each child each year up to the maximum exclusion amount, and that way they can start transferring their money to their children in advance of dying tax-free. Now, look at this. What if my spouse and I want to give a gift together? So if you're married, so you can see if one spouse gives the gift, that was the same table we just saw above, right? You see it's the same numbers, 13, 14, 15, etc. Okay, but if both spouses want to give an amount, it actually doubles. So if you and your spouse, I know this is somewhat self-contradictory, are still married, okay, you can give up to today $34,000 to each of your children tax-free, meaning you don't pay gift tax on it. Okay, so it's essentially double the amount. Now, by the way, this is not limited only to your children. Okay, you can give a gift to anybody. Okay, so let's say you have a son or daughter-in-law. Okay, they're not your child, right? They're just married to one of your children. You could give them that amount too. Okay, so let's say you've got a child who's married, okay, and you're married, so you could give each, both your child and your child's spouse, up to $34,000 a year, or a total of $68,000, okay, to that married couple, because it's per donee. And the marital unit is not considered a single donee. It's the individuals. And by the way, if you had grandchildren, you could give up to $34,000 to each grandchild. Okay. So this is all part of the estate planning process. That's why I encourage you to start engaging in this process now, because it may make sense to start transferring assets before you die, rather than waiting until after you die to transfer all of them. Okay. All right. Now, there's one other issue that we need to take into account in dealing with gift taxes. And that is, in addition to there being annual limits, there is a lifetime limit on how much you can give. Okay. So if you look right here, it says gift and estate tax exemption. The amount you can give during your lifetime or at death and be exempt from federal estate and gift taxes rose this year, 2023, from $12,060,000 to $12,920,000. So almost $13,000. Now, this is important. Obviously, you have to have a whole lot of money, okay? But if you do have a lot of money and you've been giving money to your children and or grandchildren or whomever else for a certain number of years, what that's effectively going to do is reduce the amount that you can transfer in your estate tax-free. Okay, so let's say over the last 10 years, okay, you've given gifts to various individuals totaling $6 million. Okay, what that means now is you can transfer another $6,920,000 tax-free going forward, including whatever the amount of your estate is. So if you've got an estate that's worth $10 million, right, as of this year, 2023, but you only have roughly $7 million left of your lifetime exemption, you're going to end up paying taxes, estate taxes, on $3 million. Okay, hopefully that makes sense. Okay, so as of 2023, the most you can give for your entire lifetime transfer tax-free is $12,920,000. Now, here's the real kicker. Okay, this exemption is going away in 3 years. So in 2026, it's going to revert back to the original $5 million amount adjusted for inflation, which is about $7 million. Okay, so as of 2026, you're going to lose the ability to transfer $6 million. Okay, now let me put a caveat on that. Congress can change the law to extend this deadline. Okay, and they do. I believe they've done it before with respect to this. And this is one of the ways when they're negotiating the budget each year. So see, they'll do what's called sunset this law, which means they'll have a date when it ends. And then they'll say, okay, so see, as of 2026, we're going to generate a lot more tax revenue from estate and gift taxes. And so, either the spending that we're doing will be offset by that increased taxes, or they may say, or this tax decrease will be offset by this tax increase. Okay, so they'll say that today, right? And then a few years later, when they start getting complaints from their constituents about a big increase in gift and estate taxes, they'll extend the law past the sunset date. Okay. And in that way, it won't affect all those people. Okay. So, da 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 da. All right. So this is another big reason why it's important to start your estate planning now, because these laws change, okay, and they can have big consequences on your tax situation, okay. Now, again, they can change again, right, as I just mentioned, but we need to be planning based on what the current situation is, knowing that we may need to do some additional planning if things change down the road, okay? But we don't want to leave these particular issues to chance, especially if you have a large estate, okay? Now, presumably, your advisors are up to date on this change, and they are getting with you and saying, we need to take a look at this. We need to take advantage of these, the law while we can, or not, as whatever they're advising you. That's, again, I leave that between you and your advisors. They know your situation. I'm not giving you any advice except to say, plan now, plan in advance. Don't delay. The delay could potentially be a big problem, and you may, regret delaying. Okay, so get in touch with your accountant, get in touch with your lawyer, get in touch with your financial advisors, and make sure that your current situation is either it's in line with where the law currently sits, or find out what you need to do to in order to get up to date. So I do have one attendee in the room, and Rod, do you have any questions on anything that I covered today, or on any other trust and estate matter? I'll open up the floor to you, give you a moment if you want to unmute and ask me a question. I'm happy to do so. Let's see. Oh, okay. Well, I'm gonna, oh, here we go. Okay, we got it. Oh, okay, great. Thank you, Rod. And thank you for joining me. So that's what I have for you today. This has just been a brief overview of what is, or what can be, a very complex subject. But it's something we all need to be aware of, especially that annual exclusion. That's it went up again this year to 17,000, or if you have a spouse, $34,000 if you give a gift together. Do keep that in mind. We're roughly halfway through the year now, and so if you have gifts to make, annual gifts to make, now is the time to start planning to do that and getting that all lined up. So hopefully everything is okay with my guests and their child. And as I said at the beginning, we will I'll end up rescheduling with them. So we'll have Matt and Kimmy on, Matt and Kimmy Shemek on another time. I just want to remind you, tomorrow at 11 a.m. Pacific time, 2 p.m. Eastern time, is my show Business Lessons from the Military, where we look at things like military doctrine, military history, great leaders, and distill from that ideas and information that we can use in our business lives to improve our businesses, and either our own or the ones that we work for. And then on Wednesday is at 12:30 p.m. Pacific time, 3:30 p.m. Eastern time, is my show People Making Money. My guest is Jeff Brown, and he's going to be talking about his work in holistic living a holistic life. I think you will find Jeff to be a very interesting guest, both because of what the work that he does, as well as how he was able to build a business to the point where he's able to do that work. So I hope you'll join me again on Tuesday and Wednesday. thank you very much for joining me, both here in the meeting and online. I appreciate it. And I look forward to seeing you later this week, and then we'll do it all again next week. Take care. All the best, folks. Oh, before I sign off, Marie, darling, you are my bell. See, almost forgot, but I remembered.